Getting ready to speak. We'll cut across to Menaka in just 10 seconds from now. It will be very interesting to hear what the management has to say, given that it's been a fifth consecutive quarter of disappointment. Menaka, over to you.
Well, Sonia, thanks very much. I have with me the CEO and Managing Director of TCS to talk us through what I thought was a slightly confusing quarter. The numbers tell one story, the management commentary tells another one. So let's put Chandra on the spot. Good morning, Chandra. Thanks very much for joining us this morning. First up, how do you feel about the second half?
No, second half in our sector will always be slower than the first half.
I know, but given that, and given we understand that it's always seasonally a not very strong set of quarters, how do you feel about the second half?
Yeah, again, it will be as usual. Q3 will have two headwinds. One is furloughs and lesser working days. So those things will play out.
Any worse than the second halves that we've seen so far in the last few years? Any better than the second half?
So what I said yesterday is that as of now, we think it will be very similar to earlier years. But we will get a true picture of furloughs only in mid-November or so. But as of now, we don't expect that, we don't have any signals to indicate that it will be any different from previous years.
Okay. You also said many other very, very bullish things yesterday. I'm quoting from the press conference, and I was writing this down as you were speaking. You said so much technology is happening. In my lifetime, I've never seen such a technology environment. You said this is our best order book position ever. You said opportunities are enormous in digital, and you said there is growth everywhere. For a man who chooses his words very, very carefully, I'm reading into every word you've used. Your management commentary sounds very, very bullish, and I haven't heard you sound so bullish in the last couple or at least 3 or 4 quarters. Can you tell me whether you're feeling better about the business right now?
You've got to see it in context. The first question is that is there a slowness of the technology industry per se? And is the technology industry model, IT services model itself, is it under threat? Something to that effect.
Yeah, so Gartner's revised downwards, NASSCOM's revised downwards.
The question is that technology per se is going to be embedded in every industry.
Sure.
So there is no question of technology industry is not thriving. I really believe that this is the best industry to be in because it is going to make a significant impact on every other industry. So that should be seen in that context.
We have the same faith.
Okay. So
but your comments are more bullish than I've heard in the last 3 or 4 quarters.
I think for every question I give an answer. So you always see the answer in respect to the question. If the question is about the industry, technology industry, whether it has so much opportunities or not, the answer is that it is the best ever time. There is no question about it. Then in terms of TCS, I think those are data points. It's the best ever order book for us. Yes, it is the best ever order book quarter. And I also mentioned that it is 30% higher than the best ever we had before. And these are data. And whether you want to read it into body language or you don't read into body language, it's up to you. But the point is that that's data. That's really what I convey.
You know, the reason why I'm stressing on this so much, Chandra, this morning is we've been all scratching our heads for the last 24 hours. And I know you've answered this question before, but I'll ask it again. Your management commentary yesterday was very bullish. It continues to be so this morning. The numbers tell a slightly different story, and I say slightly because A, you've missed expectations. But last quarter you told me categorically, Menaka, on a $4 billion, revenue scale, a $10 million miss or a $15 or a $20 million miss could be on account of various factors, not weakness in the business per se. So I'm buying into that, right? But if you see, this is your what? This is the slowest second quarter constant currency sequential growth that you've seen in almost 6 years. Just to give viewers a bit of an illustration. In FY14, you did about 6%. In FY15, constant currency was 7.4%, but that included the Japan business. In FY16, you've come down to 3.9%. So, I mean, the numbers are looking far weaker than TCS has reported earlier. You're sounding more bullish?
Well, I think there are two things. First of all, I give it to you that the growth expectation from the market and what we have delivered has been at odds for by whether it's $15 million, $20 million, 30 basis points, 50 basis points. We can keep arguing, but it is so for the last 3-4 quarters or
Correct.
5 quarters in dollar terms if you look at it.
Yeah.
That I give it to you. But at the same time, the trend is that from Q1 we have to see acceleration in Q2, which we have seen from constant currency terms. We have seen from 3.5% to 3.9%. But you can argue, should it be 3.5% or should it have been 4.5%, or should it be 3.9% or should it be 4.2%? That you can argue. But I have said that we have had some soft spots, 2 or 3 areas I have indicated, and that does contribute. Every area that contributes. You have quarters in which all cylinders are firing. You have quarters in which some cylinders are not firing. When that happens, you have an expectation mismatch. But unfortunately so, it is the 5th quarter from the market point of view. So I don't blame the market. I don't blame you. But that's what it is.
No, it's not just that. And I'll talk about the weak spots. I know you've spoken of Japan and Diligenta. But even volume growth, it's come in at 4.9%. So you beat your nearest competitor, which is Infosys, you know, by a bit. But volume growth, if you look at second quarters over the last few years, it's come down from 7.3% second quarter FY14, FY15, 6.1% in the second quarter, and now you've got 4.9%. So if something has shifted in this business that we're not able to understand, analysts are not able to factor in, you know.
I don't think anyone will complain on 4.9% volume growth. Okay, I don't think anyone will complain. If you take a 4.9% volume growth on an absolute number, it's pretty significant. So I don't think the volume growth is a problem.
No, it's a good number. I'm not denying that. I'm saying the numbers have been coming down though over the last 3 years. Explain that to me. You're sounding more bullish. The numbers have been coming down.
See, I think what I am bullish about is the opportunity for the industry. I give it to you saying that there has been expectation mismatch, whatever be the gap, and that has been there for the last few quarters.
So if you're bullish...
But I've given you all the data.
No, so if
I
you're
can't
bullish
explain
about
anything
the
more than
opportunities
that.
for the industry,
Yes.
then I'm curious to know why those are not translating into better
But
numbers
you are
for
just
TCS.
looking at 1 percentage point. You cannot keep looking at only percentage points. Sometimes you also have to look at the absolute growth. And it is the second quarter, two consecutive quarters of 100 million plus. And we have also done 200 million plus sometime in the past. But at least 2 consecutive quarters of 100 million plus. I think these numbers are good numbers, but there is an expectation gap.
So actually, I'm not denying that at your base and size, these are good numbers, and I'm not at all arguing against that. I'm just trying to get to the root of where and how this expectation mismatch has happened, because you were a well-calibrated company for a very long time. Analysts got it right because you know, I think the sort of the trajectory that TCS was on was visible, reasonably estimatable, you know, in that sense. Something's gone off and we're not able to understand what. Should we disbelieve what the analysts are expecting?
No, I'm not saying. I think, you know, you just have to give it to analysts, because analysts also calibrate it based on what we say qualitatively.
Yeah,
at the end of the day, we have
what?
never given guidance. We have always given qualitative commentary. Analysts also calibrate what we give qualitatively. So if there is a gap, there is a gap. We'll see how to address it.
Okay. The other point I wanted to stress here before we get into any of the other questions, constant currency growth on an annual basis has been coming down. FY12, 23%. FY13, 16.2%. FY14, 17.3%. FY15, 17%. So we've gone from 23% in FY12 to about a 16-17% range. And this year's estimate, FY16, that some research houses have put, is 12 to 13%. So that's another big derating in constant currency growth for this fiscal. You know, how do you look at these numbers? How do you look at what this year will deliver, given the history of growth with TCS?
I think constant currency last year had a kicker in the Japan acquisition.
Because of Japan, yeah.
This year it doesn't have it. So otherwise the gap is about 1 or 2%, which will explain which will be explained by the softness in the 3 places I've said.
Okay.
So the gap is constant currency gap. If you take on a year-on-year basis, it's primarily about 1.5 to 2%, and that will get explained if you account for the softness.
So you expect FY16 constant currency gap of 2% lower will be explained by Japan and Diligenta. That's what you're talking about.
The 2 or 3 soft spots I've said. I've given the soft spots. Okay. I've said it in various quarters. I've talked about Latin America sometime. I've talked about energy degrowth in a quarter. I've talked about not this particular quarter, but energy had a dip last quarter. So I have calibrated the soft spots in the last 2-3 quarters. If you actually account for that, actually what should have been the growth in those places and what we have not got it, that will explain.
So because of that, you will be about 2 or 3% lower than what you clocked last year. right?
So I'm not giving a guidance.
That's what you just said. I'm only repeating what you just said.
All I'm saying is that whatever is the gap that you will see is explained by the soft spot.
Okay, you did 13 key wins this quarter. Your volume growth, as we spoke of, is already very good. Your order book is at its highest position. Where is some of this coming from? Can you explain to us? Because I'm wondering if it is the nature of the growing digital business, which right now is only a tenth of your book, but it's the nature of the growing digital business that's sort of skewing the numbers a little bit, right? Your legacy business was maybe bigger, deal wins were bigger, maybe digital ticket sizes are smaller, the way you build is different. I'm just trying to understand, maybe that's what's changing?
I don't think that is skewing anything. At the end of the day, I think there are two types of deals that are happening. One is a transformation from a legacy environment, what I call is a simplification initiative, where customers are optimizing and also getting prepared for the future. Another one is investment in digital innovation, business model change, which will help companies to play in the digital era. Okay, and both types of deals are happening, but still large-scale deals are happening in the first kind.
So, of the 13 key wins, a majority were in the legacy business,
yes,
and not in the digital.
Or transformation deals.
This record.
See, you can't really split, because most of the times what happens is that you are transforming a legacy into a modern architecture, where you, for example, you deploy a cloud, or where you retire applications and put an enterprise cloud. So it's a combination. You can't really split saying that this is only pure legacy, this is pure digital in these kind of deals.
Okay, why are realizations down? Please note, I'm saying realizations and not pricing. Why are realizations down?
But we explained it yesterday. Realization is this quarter is primarily a mix of the geography.
Every quarter it's a mix of geography and the kind of work, right?
The only thing I can tell you is that if you take the last 3 years, we have always said that the realization is stable or our pricing is stable, and if you account for the dip in a quarter or a surplus in a quarter, when you add it, it's all coming to neutral. And it will remain so.
It's down 1%. I don't understand.
For a particular quarter, but if you look at on a yearly basis,
it will be neutral.
It will be neutral. It has been so last 3 years.
So you're saying there are no pricing pressures?
There are no pricing pressures.
You're sure about that?
See, when I say there are no pricing pressures will always be there. From our point of view, we are being extremely careful in the type of deals that we do.
So you're not discounting? If I can put it in simple English.
From our point of view, pricing will be neutral.
Okay. The other thing was the employee front. That was interesting. In percentage terms, attrition is higher. In absolute terms, it does seem to have come down a little bit. And you've announced, a bigger set of hires than we had anticipated early in the year. So you're in fact adding 15,000 people more than we had anticipated in the beginning of the year. Is that primarily to cover the gaps caused by attrition, or is it more because you feel so bullish about the demand environment?
I think it's a combination. But if you really look at the last 3 years, every year we've exceeded the hiring target that we set out. Okay, this year also will be exceeding, and our utilizations are running at 86% now, and we are investing a huge amount of training in digital, and it does take extra time. So we felt that we'll go ahead and then hire and announce that and make the hiring, and then invest in training ready.
But more demand or more attrition? I
think it's more demand, because
I think
because this quarter, if you really look at it, our quarterly attrition has come down. The reason the yearly attrition number looks higher is because of the LTM effect.
Yes, I know, I understand that.
But if you put the quarterly forward projection, it's actually 120 basis points down from last quarter.
Which is why I said that the absolute numbers are also low in that sense. Diligenta in Japan.
But still, I think I would like the attrition to still come down.
So you're working on that actively?
We're working on that.
Okay. You want to put a number to where it will be by the end of the year?
No, I don't know. If I can do that, I'll be a magician.
Okay, I'll ask Ajoy that question. Diligenta in Japan will continue to be weak spots through the rest of this fiscal, because anyways the next 2 quarters are weak quarters. So,
yes.
So it's really these are weak spots that will get fixed only in FY17. That means.
I hope so. I'll give commentary in next quarter.
Well, you don't give any guidance anyway, so...
Yeah. How can I tell you whether it'll get fixed in June next year? How can I say that?
Has the nature of the problem changed at all in your ability to deal with it or mitigate it?
No, Diligenta books are running. It's running down. So as a result, it is having a degrowth. So until we we can win some large wins. We can see some large wins. It's going to have a deceleration, and that's what it is today.
Okay, and Japan?
So, Japan is more integration-related restructuring, and I hope that in the next couple of quarters we should get it sorted out.
Okay. You spoke of deceleration in Diligenta. The other place where your business has been contracting is the consulting business. This was last year. Last quarter was down 7.7%. This quarter down over 9%. Manufacturing growth, if I look at it vertical point of view, about 1.8%, not done as well as you expected. You know, but on the flip side, you've had other smaller businesses, if I look at business line point of view, like asset-levered solutions, which have shown 32% growth. Can you quickly give me a sense of business line, geography, vertical, where you see the growth kickers for the next couple of quarters or the next 3-4 quarters, and where you see the challenges?
I think, you know, from an industry point of view, what you see in manufacturing is primarily due to the effect of Japan. That's what you're seeing.
That's the only
reason.
Okay.
Otherwise, manufacturing is doing well. The only vertical-wise I've given caution is energy, and
but energy has done not so badly this time round.
This quarter, but
from
we
5.8%
still,
or something like that.
But we still don't believe that that sector is going to consistently grow.
Okay,
yeah.
Fair enough.
So, in terms of the telecom vertical, I think we have had a muted growth, and that will remain muted. It's not going to be. I don't expect any deceleration or anything like that, but I don't think it's going to bounce back or anything. But otherwise, all the other verticals seem to be all right. And asset leverage solutions is done well primarily because both our digital platforms and banks platform have done extremely well. And though on a smaller base, their growth has been
so this is essentially
very
the use of your IP, if I understood correctly. You explained it in your analyst call last night.
Correct.
The use of your IP in various ways. Still very small.
Very small, but it's good. It's good to see the growth in using in an area we want to grow.
Yeah, sure. And if I'm pointing out the weak spots, I should point out, you know, the areas of strength and recovery. LATAM has done well for you this time.
LATAM has done
India
well.
has done well for you this time.
Well, yeah.
Are you expecting those to be sustainable?
I think LATAM will sustain from here. I think India will still reserve. I'll reserve my comments, and I'll wait. Then, in terms of consulting, actually, you know, we don't classify digital as part of consulting. Digital is embedded as part of all the service lines. That's the way we operate. And otherwise, consulting is a very small pie for us. Because I don't see much.
No, it is very small. I'm not saying no, but there's no. I mean, I couldn't understand why the business continues to contract for you.
Yeah, because most of the consulting type of engagements are happening in digital, which is getting embedded.
So you're just changing the classification?
No, it's always been, for us, we have not moved the digital as part of consulting because the digital is totally integrated with each of our industry units.
Okay.
The way we are structured.
Okay, let me talk about your main business. BFSI and North America, your main geography. The outlook on that is stable for the next couple of quarters at least?
Absolutely.
It's stable?
It's stable.
Okay. So I'll ask you again. Second half is going to be...
I'll answer again the same way. I won't change.
No, okay. So then let me, okay, before you answer the question, let me bring in something that you might not enjoy. Nobody does. Comparisons are odious. But, you know, Infosys has turned in a good quarter this time round. And the only reason I'm bringing it up is because I think, you know, there is a question on whether it's going to be able to close the growth gap between itself and you, whether it's adding to more competitive pressure in the marketplace for you, you know, what it means in terms of what India should expect and investors should expect from the country's top 2 IT businesses. So I'll put the question to you. You've outclassed them in volume growth, but they've outclassed you everywhere else.
I think I don't think that we look at it like that. As far as we are concerned, we have a very, very robust business model. We have a very strong pipeline. We have very strong client metrics. And we have invested in all the places that we want to invest, whether it is in talent development for digital, whether it is in IP, whether it is in innovation, whether it is in our own digital platforms, innovation labs, and how we co-create with customers. And all those areas we are fully invested. We have been doing it for a number of years now, especially last 3-4 years. I think we are extremely well positioned, and we don't see our performance to be under any pressure related to anyone. So that's not the way we look at it.
Okay. Final question then on how the digital business is doing. You gave us some color last quarter on the nature of the business, on how deal sizes were changing. I think there's been even further improvement in that. Your deal sizes are getting bigger, you're doing more value-added work. Talk us through what the outlook on digital is. Small part of your book right now, a tenth, but growing very rapidly.
Yeah, I think the way to, it's always very difficult to answer questions which are trying to relate every word I say with respect to a quarterly number.
No, I get
that. Having said that,
give us a longer term view, it's all right.
What one has to realize is that digital business is not about developing a few applications here or a little bit of software there. Digital now is fundamentally changing every industry.
Sure.
Okay, and industries, very large companies are going through transformation. I gave the example of retailers, where retailers were focused on running the best supply chain. Okay, from that used to be the key focus. Not that it is not important anymore, but what's more important today is what's the consumer insights you are going to have. And they're fundamentally changing that focus from being totally supply chain oriented to customer data oriented. So customer data, product data, pricing data, inventory data making huge amount of impact in these kind of industries. In manufacturing, IoT is making
impact. Bigger deals?
Bigger deals, bigger transformation, bigger partnership, those are important. But you cannot immediately say that if that is the case, what is the Q3 number in digital going to be? What is the Q4 number going to be? I think we take a fairly longer term view because we are building the business for the future.
Sure, I understand. So, I'm not asking you for Q3, Q4.
So I can't really get worked up about whether we lose 50 basis points or 100 basis points. But when it happens continuously for a few quarters, obviously the questions rise. But as far as I am concerned,
Chandra, the final comment from you, and that is that, the perception partly, and maybe this is just mine, so correct me if I'm wrong, is that TCS is this big ship that's repositioning, the oil tanker adage, right? It's repositioning to take advantage of new opportunities, and that repositioning is why we're seeing maybe numbers that we didn't expect. Growth that is not as good as the previous years. Or the other argument is that you've peaked, and from this base onwards the growth numbers will never look as fabulous as they were last 5 years. Which one would you pick as the answer to my question? Does it get better from here on? Is the best yet to come?
I'm not going to pick on any one of those statements. Fundamentally, all I would say is that the opportunity in technology business is huge. And companies like us are investing and positioning ourselves for taking advantage of that and also make an impact.
So it will get better from here on?
We'll see.
All right, Chandra, thank you very much for the interview this morning, and all the best for the rest of the year.
Thank you.
Thank you.
All right, Menaka, thanks.
To Menaka, who is now waiting with Ajoy and Rajesh. Over to you, Menaka.
All right, Lata, thanks very much. We have with us TCS CFO Rajesh Gopinathan and Global Head of HR Mukherjee. Gentlemen, to both of you, good morning.
Good
Rajesh,
morning.
what an incredible quarter this has been, not from the TCS point of view, just what we saw happen to markets, what we saw happen with China's growth. If you look at the global environment right now, are you feeling okay about the second half and next year, or are you feeling a little bit more nervous than you did, let's say, at the beginning of the quarter?
It's a tough one to call, because we see definitely confidence improving in the US, but we are exposed to the banking financial quite a lot, and there is a bit of concern that we'll need to see how the credit cycle turns and how these events pass through. So as of now, things look good. In our largest geography, in our largest vertical, we're doing well in BFS, we're doing well everywhere. But the macro question is beyond me to call, because...
No, of course, I'm not asking you to call. I'm just asking you to tell me how you feel about it right now. Are you feeling that business is a little bit more uncertain than, let's say, at the beginning of Q2 or even at the beginning of the fiscal that you had anticipated?
No, not necessarily. It's not more uncertain than what it was. But the events that you spoke about have just happened, right? I mean, so the feedback from that has not necessarily played out yet. We'll get a good sense of it as we get into the budgeting cycle, which will happen during the course of the next 2-3 months, because that's when we will get to know.
But there's no initial sort of instinctive gauging of what's going on?
as of now, there doesn't seem to be a major one. So our biggest feedback is typically from the banking side of it, and the banking side seems quite strong right now.
So spends look as you had expected them to be.
That's right.
For the next year.
Next year is too far away, right, in the context of what we are. But we don't see any major reaction or a major pullback currently.
Okay. Why are your numbers not meeting street expectations?
Let's talk about the numbers first and then the expectations.
No, the numbers we know. We heard them yesterday. We heard them this morning. We heard the analyst call. There's something here that either indicates that the expectations are incorrect, or that we don't understand what TCS is up to in the recent past, or or maybe growth is petering off compared to your best years.
So let's look at
you
it
pick
this way
what
that,
answer you think is appropriate.
I think there's no point of saying expectations are wrong, because expectations are what they are, right? Our growth trajectory there's no taking away from the fact that the growth trajectory is slightly lower than what it was in the past. But we are positioned well. So we are more, if you look at the innards of it from a structural perspective, our focus has been to build wallet share inside the customer base and to ensure that we are positioned for any technology refresh cycle that happens. And from that perspective, we are building out nicely into the digital space. But our participation is more in the adoption and in the implementation cycle, and therefore our participation is a more long-ended participation across a new refresh cycle. So I'm quite happy with the progress that we have so far, and we see market share gains or wallet share gains in most of our existing customers. We are not losing out in any of the areas. Are we necessarily participating to the same extent that some others are participating in the hype cycle? Not this thing.
Hype cycle.
Absolutely.
What's a hype cycle?
Any technology adoption goes through its period. So it takes a bit of time to build up, then it picks up a huge momentum initially, then gets to a peak, after that it tapers off, and then has a longer tail.
So when you say you're not participating as much as maybe others are in the hype cycle, what does that mean in simple English?
In simple English, it means the rate of growth that you would see in the upturn would not necessarily be the same if you are targeting the hype or the trajectory of the lower end of it. So that's the way we have positioned the company. That's the DNA of the company, that we are more on the innards of the technology rather than in the initial consulting sale of that technology.
So you preempted my next question, which was in a sense when you refer to slower growth, and these are numbers we pointed out to Chandra as well, and they're well known now. Your constant currency growth has come off from roughly 20-23% levels in FY12 to about 16-17% levels. Last year maybe even a little bit lower if you took Japan out of the mix. And now the expectation for FY16, which is the end of this fiscal, is around 12-13% levels. So that's clearly TCS moving to a different band of growth, albeit on a bigger base, no doubt, but a different band of growth, so to speak, right? On the other hand, you've got some competitors that were not doing very well in the last few years, like Infosys, doing better and better every quarter and clearly on the recovery path, whose numbers are now dazzling the street a little bit, right? So when you say that you are not on the hype growth path, are you saying you're pitching for longer term, more sustainable business, and that's why your growth numbers are looking weaker right now, whereas competitors are pitching for shorter term, more dazzle kind of business? So
it's good that you have taken that kind of a time period. So when you're starting from FY12 perspective, the way to think about it is that we went through a down cycle in the FY9 period, and into 12 we built up that momentum coming out of it. And we did very well in that, and we are currently in a consolidation phase. And we are poised for the next phase of growth, which we believe will be technology-led. The first phase of growth was more of portfolio mix-led, and our general economic recovery is what drove the FY12 growth.
Okay.
If you remember, FY12 was the year when on 10, 11, 12 were the recovery years, and we participated into that recovery. And we believe that we are consolidated, and we haven't lost on that base. So when we look at growth, we keep forgetting about that absolute, because it's a consolidation on the absolute, and we're poised for the next phase of growth, which we believe is going to be the technology refresh-led this thing of growth, and that has its own cycle. So when you look at technology adoption, it has a very strong growth initially, and then it has a slower side of it. We are on a trajectory that is to hit that adoption cycle of it, which is why we are confident about where we are positioned. So if you look at our capacity build also, we are focusing a lot on organic capacity build. Because again, as I said, we are focused on the inerts of that adoption cycle rather than the initial side of it. When you focus on the initial side of it, you will be more acquisitive in your capacity build because it's a high beta game. Whereas when you're focused on the inerts of the technology cycle, you will be more organic in your capacity build, which is what we have spoken about, the investments that we're making in our digital learning platform. So all of that, which is why we are confident about it. We are consolidating where we are and positioning ourselves to participate.
I'll come to Ajoy for the capacity build, but one quick final question to you, and that is, you've described very, very eloquently the shift in business that is taking place, including the shift in the nature of the business, the type of business that TCS is attracting now, right? Is this shift going to permit you to get back to 17, 18, 20% growth levels, or at this size and scale, those numbers are yesterday's numbers and no longer doable in the foreseeable future?
See, we got to think about size. Whenever we think of size, we always think of it from a historical context, right? When we were $5 billion, it was very large compared to $1 billion. When we are $15 billion, we are much larger than that. But inherently, 15 is, it's not as if it's the largest one. There are companies that are much larger and who have participated in growth a lot more. So we don't believe that we are at a point where the size is an inherent disadvantage. We believe the scale in reverse is actually an advantage, which is what that organic capacity build is all about.
So I'm reading into that there is the possibility that you could go back to 17, 18 and 20% constant currency growth.
Every time you put a number, a forward-looking number in front of me, I will just blank out of it.
No, this is a backward-looking number. It's the number that you already achieved in the past.
So in the past,
will it repeat is my question.
That's the forward-looking number. So yeah, I'll always bat you down on that.
Okay. But I think you have broadly answered that things are looking better from here on.
So we are poised.
Last year was a tough one. This year has not been, as good as previous years either. This is probably your worst second quarter in 5-6 years. So, I mean, things will get better from here on. That's not guidance. That's just, hope.
So it's a quarter in which you delivered $120 million of incremental revenue.
And your competitor has delivered $136 million in incremental revenue.
Absolutely. But then, look, think about it this way.
On a much smaller base.
So there is a question of what is the run rate, what is the asking rate, and then there is a question of actually batting in the middle and ensuring that you pick up the runs, keep the scoreboard ticking, put the runs on the board, and we have decent runs on the board, so we will build out of that.
Okay, fine. Ajoy, this 15,000 extra in terms of hires anticipated at the earlier part of the year and now in this fiscal, is it mostly to help fill the attrition-led gaps? Or are you hiring because you feel very bullish about the opportunities coming up and you need to start building strength?
See, overall what you hire, the workforce planning that you do, it takes into account various factors. The attrition is definitely one of the factors. But primarily it is also driven by the kind of growth that you see in the future. That does not mean only the next quarter or quarter after that. Also because some of the people will be joining even in Q4 when I say I'll be hiring 15,000, and that will primarily be for our requirements going forward. So given where we are, first 2 quarters, we have done already 45,000. And initially I had said that I will be hiring 60.
And now it's 75.
So now I'm saying 75 because the way where we are poised at this point in time, I'm sure that we will definitely go very close to 75 given our future needs. So it's primarily from that point of view, yes, it is the business growth that we see. I think Chandra announced the kind of order book that we have in hand, the way things are panning out. Looking at the technology refresh, the kind of competencies that we need. So what is the kind of skills that you need, that would also determine what is the kind of hiring that you have to have. So it is all these factors which are playing into it, and then we are looking at building that capacity for our needs that we see in future.
So your utilization level, come on.
All right, that's the management of TCS, but we need to move on with the market as well. Remember, the sum and substance from TCS is that the second half of the year will be slower than the first half. But let's get to trade.